Very good evening, delegates. Welcome to today's CPE meeting on Ind AS 109, Financial Instruments including case studies on expected credit loss. The session will be handled by CAR Venkata Subramanian. Venkata Subramani, fondly called as Venkat, is a Director Complaints Automation Practice Lead at Protomines. Protomines is a leading Regitech consulting and services company based in California, serving a growing list of customers nationwide and internationally through its operations spread across USA. Earlier, Venkat was product manager for hedge accounting at Calypso. Calypso Technology Inc. is a leading provider of cross-asset front-to-back technology solutions for financial markets with 20 years of experience in delivering cross-asset solutions for trading, processing, risk management and accounting. Calypso is being used by several banks, financial institutions across the globe. Prior to that, Venkat was the head of business management and operations control at Northern Trust Bangalore. Northern Trust Corporation is a Chicago-based bank. Venkat also holds a diploma in IFRS from ACCA, United Kingdom. He is an All India rank holder in Chartered Accountancy course, has an overall experience of more than 3 decades. He is co-opted as a special invitee to the Accounting Standards Board of ICAI for the year 2019-20. He is a visiting faculty at CA Institute for the Ind AS IFRS certification courses for the last 10 years and has conducted specialized courses on financial instruments for several banks and financial institutions. He has authored many books: Accounting for Investments Volume 1, Equities, Futures and Options; Accounting for Investments Volume 2, Fixed Income Securities and Interest Rate Derivatives; Financial Instruments as per Ind AS, published by Wolters Kluwer. With this brief, I present before you a profile CAR Venkata Subramanian. Please give him a big round of applause. Before we hear sir, let us rise for ICA motto as a mark of respect to our mother institute. Thank you, delegates. May now request member Jagannathan sir to come forward and present a memento to the speaker for today, Venkata Subramanian, as a token of our SIRC's love and affection.
Yes, sir.
Requesting delegates to occupy the front rows. From this perspective, all the front rows are very blank. It's not occupied. It's a very limited audience. If you come forward, it will be an interactive session. I now request all the delegates, please. Thank you. Over to Venkata Subramanian, sir.
Good evening, all of you. It's really a pleasure to be back at the Institute once again. If you come closer, I think there are going to be some calculations I'm going to show, and it might be easier for you to look at that. So in that perspective, it will help if you come a little forward. So the topic today is financial instruments as per Ind AS 109. Before we start about this topic itself, it would be in the interest of all, that we give a little bit of genesis about this 109 itself, Ind AS 109 itself. As per our AS, the existing accounting standards, IGAP, we do not have a comprehensive accounting standard that deals with all aspects of financial instruments, and there has been a lacuna for a long time. So what we did was, during 2008 and 2009, we hurriedly went and copied the counterpart, which is IAS 39. Then you had this IAS 32 and IFRS 7, and then called it as AS 30, 31 and 32, and made those standards as part of our AS literature. It was supposed to be mandatory from 1st of April 2011, and on 31st of March 2011, that is one day before that, all the three standards were withdrawn. So those standards never saw the light of the day, and it has never been either recommendatory nor mandatory. And fortunately for us, Ind AS 109, which is an exact replica of IFRS 9, was adopted as it is. So what are the benefits? Why I am saying it is fortunate? It is because we do not have the problem of unlearning the predecessor standard, which is IAS 39. So we were directly given an extremely wonderful standard. I am a great fan of IFRS 9 because it has taken away a lot of subjectivity and it is completely objective. So we are given directly the new standard, which is IFRS 9, and which our accounting standards were adopted sometime just before Ind AS was made mandatory, sometime during August 2014. IFRS 9 was officially promulgated on 24th of July 2014. Before that, we had this IAS 39, and many of you may be fortunate not to even know anything about it, as I said earlier. But those who know about it, IAS 39 underwent dramatic changes. There were, I would say, 4 set of changes that were brought in. The first 2 were in 2009 and 2010, relating to classification and measurement. Then in 2013 came the major amendment relating to the hedge accounting. And then in 2014, 24th July, the final phase or the final installment of IFRS 9 was announced, relating to impairment. And that is going to be the main topic of our discussion today. When it was announced, IASB said categorically, before that, a little bit of more introduction on this one. See, the standard setters on both sides of the Atlantic Ocean, namely IASB and FASB, which respectively accounts for IFRS and US GAAP respectively, jointly wanted to form an accounting standard relating to financial instruments, and that is how the whole project started, and this started in 2002 onwards. It was not taken up very seriously, but when the entire world was hit during 2008 due to the financial crisis, they again came together and said, okay, we need to expedite this particular project. So they started to have more serious deliberations, and they were seeing eye to eye basically. So 2009 and 2010, the amendments relating to classification measurement was more or less unanimous from both the sides. Then in 2013, hedge accounting, perfect synchronization. And in 2014, when these impairment standards were announced, they agreed to disagree on very, very subtle aspects, which probably we will see towards the end of this session. What are the distinction between the impairment provisions as per US GAAP and impairment provisions as per IFRS 9, which is what we have adopted in Ind AS 109. So from that perspective, the IFRS has always been a principle-based standard, and US GAAP has always been a rule-based standard. We are all aware of that. But the principle-based standard doesn't mean that it has got to be very subjective. Right? It can be objective. It can, even though those are principles that are laid down, it can still be made objective, and that's what they did. So from that perspective, there is a sea of difference between what was there in IAS 39 and what is there currently in IFRS 9, which is Ind AS 109. So I just want to give an overview of that so that we know for sure that there is something new in that. This is relating to the classification of financial assets. Now this classification of financial assets, in respect of all the assets that are within the scope of Ind AS 109, we can broadly classify those assets into 4 categories. Financial assets are either cash, or it can be equity investments, equity instruments of another company. It can be a debt security, investment in debt security, or it can be a derivative instrument, so long as the fair value is positive. If the fair value is negative, then it becomes a financial liability and not a financial asset. So these are the 4 broad categories of financial assets, so to say. Okay, we can say that I'm deliberately excluding this from those financial assets which are issued where the contract is settled by its own instrument. So let us keep that outside the purview of our discussion today, because it's not relevant from today's perspective. As far as cash is concerned, it is to be measured at amortized cost, because you have to have a multiplying factor of just 1, right? Cash multiplied by 1. So there is no valuation so long as we are talking about a stable economy. If it is a hyperinflationary economy, it is different. But under normal conditions, it is to be treated as amortized cost. As far as derivatives are concerned, derivatives are always valued at fair value. So the valuation resulting in profits or gains are recognized in the profit and loss account. So previously we used to say, if it is a gain, don't account for it. If it is a loss, recognize it immediately. There is absolutely no logic behind that. Whether it is a profit or loss, it has got to be recognized in the P&L. The reason is because IFRS, the very principles of the conceptual framework tells you that there cannot be any hidden reserves. Hidden reserves is completely prohibited. So if the derivatives are to be valued at fair value, the fair value changes should be recognized in the profit and loss account. So those 2 are outside now. Now we can eliminate those because we know how it is to be classified. There is not much of a challenge. Then we are left with 2 other categories. One is equity instruments, investment in equity instruments. The other one is investment in debt securities. Now, investment in equity securities, there are only 2 ways by which it can be settled. In the sense that will you receive the money from the company? You will never receive the money from the company. You will receive only when it goes into liquidation. So you will have to hold it so long as the company is in existence. Perhaps you may be able to sell it to someone else. So the classification is basically, predominantly the classification is fair value through P&L. So that means the equity instruments will have to be fair valued irrespective of whether it is listed or unlisted. So if it is listed, we already have the quote. If it is unlisted, then you have the big challenge of getting it valued, and if it is a listed company, on a quarterly basis, because you have to value this on a quarterly basis. So if you decide to classify this as fair value through other comprehensive income, the choice is basically yours. You can exercise the choice, and this choice will have to be exercised without undue delay. You cannot say, today I will buy the equity instrument, at the end of the year I will see, depending upon whether it is profit or loss, I will decide whether it should be whether it should be classified as FVTPL or FVOCI. No, that's not possible. You will have to decide without undue delay. And if it is not meant for trading, there is a choice that is given. I'm always very reluctant to use the word option, because option has got different connotations in the derivative, so that's why I always use choice. So there is a choice that is given to the investor to state that the investor can classify this as FVOCI, which means the difference in the fair value from period to period will be recognized in the other comprehensive income, which is part of your reserves. So to that extent, there is no, so far we have not seen any subjectivity at all. It is very objective. The criteria is very objective. So you have to decide whether it is meant for trading. If it is not meant for trading, the choice is yours to say that you want to classify this as FVOCI. And if you value it as FVOCI, it is an irrevocable option. You cannot later on say, no, I want to go back to FVTPL. That is not possible. It's an irrevocable option. So far, so good. That's all as far as the equity instruments are concerned. Now let us come to the next category, the final category, which is the debt securities. Now this debt securities, you will get the money back from the company, because on the maturity date, the company has to pay you the money back. So it's a debt security. You will get some fixed return. It could be a fixed income, or it could be a variable. It could be based on fixed rate of interest, or it could be floating rate, which is fine. But you will ultimately get the money back from the company, or you can always sell it. So there is something called as maturity, because you may hold it till maturity. As per IAS 39, there was a category called as HTM, which is held to maturity. So people also colloquially call it as Hindu traditional marriage. You have to live with it till maturity. So here, what is the criteria for defining this as HTM? Now HTM is a bad word as far as IFRS 9 is concerned. You are not supposed to use that word. So instead you just say it is an amortized cost basis. Now the criteria previously used to be that you have to have an intention to hold it till maturity. What is intention? You will never know what is my intention of taking this class, right? Like that, I don't know what is your intention of attending this class. So intention is completely subjective. And the second criteria is your ability to hold. What is ability to hold? How do you define ability? So they used to say, okay, if the share capital is say 1 crore and you have made an investment of 1 crore in some debt securities, you cannot say that I want to hold it till maturity, because there is no ability. What will you do for your day-to-day activities? But that is not a right argument, because you can always borrow, right? For your day-to-day expenses, you can always borrow. So that's completely subjective. So this was the previous state of affairs as far as IAS 39 is concerned. Now that's completely gone now. Now it is very, very objective. Now how it is objective? The criteria first is The first question to be asked is, what are the characteristics of the cash flow, contractual cash flows? You are receiving basically a financial asset is basically a series of contractual cash flows, the right to receive contractual cash flows. What is the nature of these contractual cash flows? Does it represent solely payment of principal and interest? If it represents solely payment of principal and interest, then at the instrument level, it qualifies to be classified as amortized cost security. That means, in all probability, you are likely to hold it till maturity, or that instrument qualifies for you to classify it as amortized cost security. Now, this amortized cost security is a very, very coveted class. The reason is because you are not going to value this on a fair value basis. So that is the reason why it is a very coveted class. We'll talk about it a little bit later. Now, if the first condition is satisfied, which is executed or which is done at the instrument level, because it is to be done at the instrument, and if the first test passes, it passes for everyone. It passes for you, it passes for me, because it is done at the instrument level. The second test is, what is the business model objective of holding this financial asset? Is it to collect only contractual cash flows? If it is to collect only contractual cash flows, then it qualifies to be classified as amortized cost security. If the business model objective, please note there is no intention. Okay, the business model objective is defined as by the key personnel of the company. So if the business model objective is to collect contractual cash flows and also to sell only once, and also to sell, then it is classified as FEOCI. If the business model objective is to collect contractual cash flows and also to buy and sell, keep buying and selling, which means basically trading, then it will be classified as FETPL. If the very first test, namely the SPPA test, fails, then it has to be classified as FETPL, which means you will have to find out what is the fair value of such instruments and recognize it in the P&L. Now, as far as this SPPA test is concerned, it is solely payment of principal interest. The cash flow should represent solely payment of principal and interest. What is interest? Interest is a consideration for time value of money, predominantly a consideration for time value of money. It can also include certain compensation towards the liquidity risk and the credit risk that is undertaken. There is some liquidity risk and there is some credit risk. It can also include a little bit of administrative cost and a little bit of profit margin. So these are all the four components of interest. If these components of interest are not present, then the SPPA test fails. For example, I'll give an example. If there is an investment that is made and you get the interest at, say, 12%, if the Nifty stays above 12,000. If the Nifty falls below 12,000, then the interest will have to be paid at, say, 20%. That is the case. Then the amount is determined based on the time, based on 10% or 12% depending upon the conditions, but it is not predominantly a consideration for the time value of money. So the first test, SPPA test, will fail. For example, if you lend some money where the interest is reckoned based on, say, the profitability of the enterprise. If the ROI or if the gross profit or net profit is above 15%, then the interest will be paid at, say, 12%. If the gross profit is below that, you will demand a higher percentage. Then it is not a consideration for time value of money. Then the very first test, SPPA test, fails, and such instrument will have to be classified as FVTPL instrument only. Okay. So this way it is very, very objective. Now there is solid reasoning behind this classification, and that is the reason why I said it's completely objective. Okay, we will just go through this quickly. Same thing. Is the asset an equity investment? The first question, whether it is an equity investment. If the answer is yes, then is it held for trading? If it is held for trading, then it has to be classified as FVTPL, called equity. FVTPL equity. Then if it is not held for trading, then the question that is asked is, have you elected this option, the choice to value this or to classify this as FVOCI? If you have executed this choice, then it will be classified as FVOCI equity investments. Okay. If it is not an equity investment, then it has to be a debt security, because we have clearly removed the derivatives and cash from this picture. So it has got to be debt securities. So the debt security, what is the contractual cash flow characteristics, or the assets contractual cash flow characteristics represent solely payment of principal and interest. If the answer is no, then straight away that will be classified as FVTPL. If the answer is yes, then what is the business model objective? Is the business model objective to collect only contractual cash flows? If the answer is yes, then it will be amortized cost. If it is not, then what is the business model objective? Is it to collect contractual cash flows and also to sell but once, and also to sell only once? Then it will be treated as FVOCI. FVOCI, debt security. Okay. Now the reasoning why you have separately debt securities and equity investments, FVOCI, is because whatever is classified, or whatever goes into FVOCI equity instruments is not plowed back to the profit and loss account even after the asset is liquidated. But in the case of debt securities, if it is liquidated, then whatever is parked in other comprehensive income will have to be recycled back to the profit and loss account. Anybody knows why is this?
The amortized must be, first of all, how the profit, over a period of time that profit keeps going, not to be.
No, it's not amortized cost, it's fair value. I'm talking about this FVOCI. Amortized. So let me give an example. I don't know if it's an iPad I would have written, but okay. Now you bought a equity instrument at 100 rupees today, and next year it becomes 110 rupees. So the 10 rupees, it is an investment that is classified as FVOCI, let us assume. The 10 rupees will be taken to the other comprehensive income. Then the year after, assuming that it is 125, then incrementally that 15 rupees will be taken to other comprehensive income. So you will have 25 rupees in OCI. And in the third year, let us assume that it is sold for 135 rupees. Right? So this 10 rupees will go to other comprehensive income, and there will be 35 rupees lying in OCI on account of this investment. The investment is liquidated, so it is already sold. That 35 rupees will continue to remain in other comprehensive income. It does not come back to the profit and loss account. Same example, if it were a debt security, then it would come back to the profit and loss account. And this is what is given in the standard. So I want you to tell me if you know why is this.
It
Anybody?
is not part of your business operations.
Huh?
It is not part of your business operations or main objects of running the business, so should not be included in your net profit for presentation.
Okay. Okay. Any other answer? See, the answer for the first question, that is why this cannot be taken to the profit and loss account, why it remains in OCI, and is the answer is different from the answer to the next question as to why the profit will have to be taken to the P&L, will have to come back to the P&L. The answer is different, even though there is one common line between those two. Okay, let me explain to you that, because why I consider this understanding the answer for this question is very important is because then you would have understood the classification concepts, the reasoning behind this classification. I think this occupies 1/3 of your financial instruments, 109. 1/3 of this is classification and measurement. Measurement is not part of 109, it is part of 113. I mean, from that perspective, 109 only tells you how you account for it, but not how it is valued. Okay, that is under 113. So this constitutes 1/3 of the big standard 109. So that is why, and this concept is very, very important. Okay, let me try to give you an answer for this one. Now, I will give you the last ones. Okay, this is the answer. Now, as far as these equity instruments are concerned, the classification of these equity instruments into FVOCI, that's why I said FVOCI within brackets equity instruments, is by what? Is by exercising a choice. You are exercising the choice. Okay? And why would somebody exercise this choice? What is the reasoning? Why would somebody exercise this choice?
Because he wants to
You
retain
want
it
to hold
in
it
FV,
for a long time.
because he wants to retain those increments in the FVOs, other comprehensive income.
No, that is the corollary.
So you want to retain, it's some sort of business strategy, you want to hold the assets for a long time.
No. Oh, no. I'm asking, why would you classify this as?
Yeah, that's what. I'm planning to hold it, I'm not just planning for a short-term trading to make a quick buck. I'm planning to hold it for some more time, like say strategic investment or something, 10%.
Okay.
It is now below 20%. It is not investment income or a subsidy.
Okay.
So
What is the other answer?
To protect the P&L from
Exactly. So that is a simple reason. So you don't want the P&L to be unnecessarily affected by the movements in the equity, because equity is subject to be a lot volatile, right? So that is the reason why the choice is given. Basically, you don't want the P&L to be fluctuating. So basically, to protect the P&L, right? So look at it a little deeper. If you say that your P&L will be protected so long as you hold this investment, and you will lose the protection when it is liquidated, does it make any sense? The very purpose is defeated. The very purpose of granting the investor the choice of classifying this as FVTPL is defeated, because it doesn't make sense. So I'll be holding it for 3 years, but then the 4th year I'm still hit with a big profit or loss, right? That is the reason why it stays back in OCI. Okay, that is one. Now let us get back to the debt security. Now, as far as
So, is this you said instrument wise at level? So, can I have one classification, one equity and another classification for it?
100% possible, same equity instrument, same Infosys. Let us assume you bought Infosys. You bought Infosys 2 lots. One lot you can say I want to classify it as the FVOCI. Another lot you can classify it as FVTPL. Absolutely possible. Okay. Now let us come to the debt security. Now debt security, because this is to be done at instrument by instrument level, debt security is at a portfolio level. Okay. Now the debt securities, as far as debt securities is concerned, FVOCI classification is, can you exercise the choice and classify it as FVOCI? No,
Based on
you cannot. It is by what? How is it determined? It is by,
The criteria defined.
you have to apply the criteria. Depending upon the criteria, it is classified as FVOCI, right? Okay. Now, why is this criteria? The criteria is fixed because, as far as this FVOCI instruments are concerned, the predominantly the objective is to collect contractual cash flows only, but you may sell when the opportunity is there. When there is a good opportunity, you may sell. That means you may not sell, but you may sell. So from a balance sheet perspective, the investor in the company which is holding this, okay, would like to know if it is sold to tomorrow on 31st March it is presented, right? If it is sold on 1st April, how much would the company get? So we want to know, the investors would like to know what is the fair value, and that is why, because the company can sell at any time once, even though it is once, the company can sell tomorrow. If it sells tomorrow, what should be my profit or loss? I should know that. That is the reason why it is valued at fair value. But then you may not sell. You may, in all probability, hold it till maturity. So even though the difference, the incremental value, incremental profit is part of the shareholders' wealth, shareholders' net wealth, it is not yet realized. Only when it is realized, it becomes part of the P&L. Nevertheless, it is part of your shareholders' wealth. So it is taken to the OCI, and when that event happens, so it is not happening on maturity, it may happen on maturity, but it can happen any time before. When that event happens, when it is already crystallized, and when it is already crystallized, you have to move it back to the P&L because it is your profit. Do you understand this portion? Okay, this according to me is the essence of this classification criteria.
What about hybrid instruments like convertible debentures?
That is hybrid investments. Now you don't have to segregate. If it is a financial asset, you don't have to segregate. So previously you have to segregate. Now it is either. Okay. Is it? Are you able to understand, or is it going above? Any doubts so far? Please give the feedback. Are you able to understand? Because I find many people going away. I don't know why. So, I mean, are you all with me?
Yes.
Okay. Now, let us get to the next one, the impairment model. Okay. Now this one third of Ind AS 109, you have already completed. You can take it like that, because this is the essence. The essence is already there. Okay. There are a lot of other details of that, but this is the essence. Now the second 1/3 is about this impairment. Okay. Now this impairment model is very interesting because this is now based on the expected credit loss. So previously we were using the incurred credit loss model. So we used to recognize only based on the loss that is already incurred. So incurred loss model. And also previously we used to do what is called as sort of a provisioning. We arbitrarily say, okay, 0 to 30 days provided 3%, 30 to 60 days provided at 5%, etc. Those were arbitrarily, and so long as the percentage is substantial, the audit is very happy. Okay, fine. So you used to agree for it, but now that's not possible because there is nothing like there is no hidden reserve. You cannot have hidden reserve. if the provision has to be, if the loss allowance has to be made for X, it has got to be X. It can't be X plus 1 or X minus 1. That's not possible today. Okay. Now, so the model that is envisaged is what is called as an expected credit loss. So you find out what is likely to be the loss, and that's what you need to recognize. Now, when you say what is the expected credit loss, it is a moving target, because today the loss can be something, the expected loss can be something, in the next quarter it can be something. So always try to be closer to the reality. So how can you be closer to the reality? You have to find out not only the historical loss that has been already incurred, but also what is likely to be the future scenario, right? So the forward-looking information will have to be factored into for finding out the expected loss. Probably this is the first time you will see that we never do any accounting based on a forward-looking model, right? It is rather prohibited, because it will become a conjecture. It's not historical rate, but it becomes your conjecture. It should not be the case, but this is an exception to that rule. The reason is because the investors should not have the shocks. So suddenly they say, oh, everything is fine. Suddenly in 31st March, you find that there is a big shock coming, right? There is a huge default coming. That default did not come on 31st March alone. It has been brewing for some time. So you already probably had a hint of it on 31st December itself when you prepared the balance sheet. You will have to record that. So that is the reason. So you should always try to be closer. So which means this allowance need not always necessarily be a one-way traffic. That means it need not necessarily be an expense. It can also be an income, which means the provision can be reversed. So you can go back. So that is possible. You can go. So the previous model, which was prescribed by IAS 39, was criticized on the fact that it was too little and too late. It was too little and too late. Now we are going to do it based on a very objective basis, how this is to be computed. Okay. So this is based on the entity's expected credit loss on all financial instruments. Now, this is to recognize expected credit loss at all times and update the changes in the credit risk of financial instruments. The model is forward-looking, so you have to take into account the historical and also the forward-looking information. This eliminates the threshold for recognition of expected credit loss. So previously you start accounting for it only after it crosses the threshold, but now that's all removed, and it is, in fact, you have to provide for it on day one. When I say day one, it is not the day on which you buy, but the first period for which you compute your present your accounts. So more timely information is provided, and the same impairment model applies to all financial instruments. So there is just one impairment model. Previously there used to be different models for different classes of investments. Like for HTM it used to be different, for AFS it used to be different, and all those stuff. Now those things are all gone. Now there is only one straightforward model. What instruments are covered? Financial assets, debt instrument measured at amortized cost, or FVOCI. Now this is very important for you to understand. See, when a particular debt security is valued on a fair value basis, where is the question of further loss on that? Because already it is valued at fair value, right? So this is the question. Now this is lot of discussions on this have taken place, and the answer to that question is, while the fair value, how is the fair value computed? Basically, if it is a debt security, for a debt security, the fair value is computed based on the current risk-free rate, and you have to add the credit risk has to be added, and you will have to discount all the future cash flows based on this, and you arrive at a fair value. So what is already considered for the fair value, for fair valuation of this instrument is the credit risk is considered. Okay, the interest rate, the interest, whatever is the current interest is considered, but what is not considered is the default risk. The default risk is still not considered even though you value the debt securities on a fair value basis. Okay, so that is the reason why that is the reason why you have this fair value FVOCI also covered under the scope for ECL. Okay. Then you have this loan commitments. So all of those things are not measured at fair value. Financial guarantee contracts, lease receivables, then contract assets within the scope of 115, all your receivables. Then out of scope, equity investments. Equity investments are valued at fair value. Either even if it is FVOCI or FVTPL, it is all at fair value, so that is clearly out of that. Then loan commitments measured at FVTPL, then other financial instruments that are measured at FVTPL are all outside the scope. What is, as far as the fair value, even though it is valued at a fair value basis, what is included is only the debt securities. All other things are outside the scope.
What is the difference between,
Sorry?
can you go to the previous? What is the difference between contract asset under 150 and the trade receivable? Because under 115, you include everything.
Yeah, it is the same. It's the same only. Same. Yeah. Then equity investments. Equity investments are outside the scope because they are already accounted at FVTPL or FVOCI. Okay. Accordingly, previously what happened, there used to be impairment on equity investments also. I don't know how many of you know that. Previously, we used to do impairment even on equity. Now that is not there because the test used to be what is called as prolonged decline, or in the US GAAP they say OTTI, other than temporary impairment. Other than temporary impairment used to be covered under this one. So those things are very, very subjective. So significant or prolonged decline test proved to be very
Like Indian GAAP, old AS6, I think permanent diminution in value.
exactly. Yeah. So that is what is called in the US GAAP as OTTI.
Other than temporary.
Other than temporary, OTTI, other than temporary. So that is now not, it's very, very subjective, right? So that is the reason why it is removed. Okay, now let us see what is the general approach to impairment. Incurred loss model is replaced with expected credit loss. So expected losses are the present value of cash shortfalls over the expected life of the financial instruments. Okay. Now, throughout the standard, you will find that what is contemplated predominantly is the discounted cash flow method. Okay, for finding out the impairment loss. So you have a series of cash flows that are going to happen on a financial asset. So if a particular default event occurs, how will the cash flows be affected? So you have to find that out and then find out the cash flows based on the occurrence of this default event and try to do the fair valuation of that. So the way it is defined is that it is the cash shortfalls, the present value of all the cash shortfalls occurring over the entire life of the asset. So cash shortfalls is defined as the difference between the contractual cash flows and the expected cash flows. So whatever is the contracted cash flows and whatever is the expected cash flow, the difference between those two are the cash shortfalls, and you find out the present value of that by discounting this instrument based on the EIR of that instrument. Now this EIR is another concept which is covered here. So this effective interest rate is a very key concept which was not there in the previous, as per our idea. We never had this EIR concept. Now supposing you had an investment of, you bought some security, let us say you bought some debt security at say 85 rupees, which has a maturity of 3 years from now and which pays a coupon of say 6%. So we used to treat that 6 rupees, because the face value, let us assume the face value is 100 rupees, we used to account for the 6 rupees as the interest income every year, year after year. And then at the end of third year, we account for when it gets mature, when the instrument is mature, you get back 100 rupees from the company. So the difference between your cost 85 rupees and what you receive 100 rupees is treated as what?
Profit on sale. Profit on redemption.
Profit on redemption, or more like a capital gains. We used to call it more like a capital gains, right? But then it is completely not correct, because it is in the nature of interest income which is deferred. So what we get back, that 15 rupees, is actually part of your effective interest. So you will have to find out the IRR. So which means there is a cash outflow of 85 rupees today and an inflow of 666 and 106. Find out what is IRR. Roughly it has got to be 15 divided by 3 years. Roughly 5 rupees should be added. So that means if the coupon is 6 plus 5, 11 rupees should be your effective interest rate on a straight line basis, but it won't be 11, it will be slightly different. It will be actually be more than 11. So the interest income is recognized based on the effective interest rate and not based on the coupon. So that is one of the key concepts of 109. Now the reason why it is very important is that as far as these cash flows are concerned, whatever cash flows that are likely to occur over the remaining period of the asset, life of the asset, you will have to discount this based on the effective interest rate of that security. Okay. Now this effective interest rate is something that is reckoned for every instrument whenever it is purchased. On the date of purchase, you reckon the effective interest rate. Okay. So the effective interest rate, once it is reckoned, never ever undergoes a change for the entire life of the asset, except for one exception. There is only one exception to that rule. Otherwise, whatever is the effective interest rate, that remains the same for the entire life of the asset. That exception is on account of the discontinuation of hedge accounting, where the fair value hedge is applied on to hedge interest rate risk. So when there is a discontinuation of a hedge accounting to cover an interest rate risk, and where the method is fair value hedge, then only in that situation the effective interest rate undergoes a change. Just keep that in mind, because now we are not covering hedge accounting, so I am not going to deal with it, but I want to tell you that EIR can undergo change only in this situation. Okay. So this EIR is very important, because that is the rate at which it has to be, all your cash flows will have to be discounted. Now cash shortfall, we saw what is a cash shortfall. The difference between the cash flows due as per the contract and what is likely to be received based after the default happens. Now this expected credit loss is done in IFRS based on 3 stages. Okay. from a probability of default perspective, there are only two stages, which means it is based on the probability of default occurring over the next 12 months or the probability of default occurring over the entire life of the asset. So when is the first one applicable? When is the probability of default occurring over the next 12 months applicable? It is when there is no substantial increase in the credit risk from the time you bought till the date of valuation. If there is no substantial increase in the credit risk, then you have to you have to consider the probability of default for only 1 year, or it is actually a rolling period of 12 months. And if that probability of default were to occur, what would be the actual cash flows? We'll have to compute the cash flows for the entire life of the asset, not merely for the next 1 year, but for the entire life of the asset, and that becomes your expected cash flows. You already know what is your contracted cash flows. So contracted cash flows minus expected cash flows discounted based on the effective interest rate of that instrument will give you the expected credit loss. So this is for those assets on which the credit risk has not increased significantly from the time it was purchased. But where the credit risk has increased significantly, then the probability of default will have to be considered for the entire life of the asset. So obviously the probability of default will be more because you will have to consider the entire life of the asset. Say for example, if the instrument has a total remaining maturity value of period of say 5 years, then you will have to find out what is the probability of default occurring over the next 5 years. And if that probability were to occur, what would be my cash flows? And that would be the expected cash flows. You already know what is the contracted cash flows. Contracted cash flows minus expected cash flows, present value. Now for these two cases, this is called a stage 1 and stage 2. Stage 1 is for all assets. Stage 2 is for those assets on which the credit risk has increased significantly. And in these two cases, the interest income is recognized based on the gross value of the asset. That means you do not consider the loss allowance, or in other words, loss allowance is not reduced from the gross value of the asset. Supposing on a value of say 1000 rupees, you find that the expected credit loss is say 50 rupees, you will still have to find out the interest income on 1000 and not on 950 rupees. So that is as far as these first two stages are concerned. Now the third stage is what is called as defaulted. That means it is already credit impaired, it is defaulted. You were calling tiger from day one, the tiger ultimately arrived. So it became defaulted. When it becomes defaulted, then you will still have to find out what is the probability of default occurring over the entire life of the asset, which is already 1 because it has already occurred, and find out what is going to be the cash flows that is going to come after this default has already occurred, and find out the cash shortfalls, find out the present value. Now the only difference between stage 2 and stage 3 is that here the interest income is recognized on the net, or what is called as the amortized cost. The amortized cost is the gross value of the asset as reduced by the provision, the loss allowance. So it is called as the loss allowance, as reduced by the loss allowance is your amortized cost. So interest income is recognized on the amortized cost and not on the gross, as far as the third thing is concerned. So we can recapitulate, I already explained, we will recapitulate the same thing. When the credit risk increases significantly from the initial recognition. So this is very important. Now let me give an example. Supposing you bought two assets. Okay, one asset is rated C. Okay, another asset is rated A, and both these assets at the end of say 6 months are rated C. Okay, the first asset was bought at C and it continues to be at C. The second asset, when you bought it was A, now it has become C. So on the second asset, the credit risk has increased significantly from the date of inception, from the date of purchase. So what is to be considered is not the absolute level, absolute credit risk, but the relative credit risk from the time you purchased till the date of the valuation. So what is the relative credit is what you need to consider. So what is meant by significant increase in credit risk? So there are various parameters by which you can observe that the credit risk has increased significantly. There is no definition, there are only some examples. The entity uses the change in the risk of default occurring over the expected life of the financial instrument. Whether the risk of default has increased significantly since initial recognition, that's what I explained. And there is a rebuttable presumption that if the days past due exceeds 30 days, it will be treated as if the credit risk has increased significantly. Now this 30 days is there, it's just a rebuttable presumption, which means that you can always say, okay, as far as this particular case is concerned, even though it has increased, it has gone beyond 30, you may still say that it is not, the credit risk has not increased significantly. There are some exceptions to that. One of the exceptions is that due to some administrative reasons or administrative problem, you find that it goes beyond 30 days. Or you can also have to prove historically using a proper regression analysis, proper correlation regression analysis, you can say even though the credit risk has increased, even though the number of days past due has increased beyond 30, it has gone up to 60 also sometimes, but then it has never become defaulted. So you can still say that the credit risk has not increased significantly, that you will have to make a proper analysis and then prove. Otherwise, 30 days will be taken as the cutoff. Okay. Now, default. Default is for moving from stage 2 to stage 3. So, increase in credit risk is from stage 1 to stage 2. Now, stage 2 to stage 3, there is no definition of the term default. There is no definition that is given. So, each entity should be consistent with what is used for internal credit risk management purposes. Now, there could be some qualitative indicators. We will see a little bit later what are all the different types of indicators, breaches of covenants, etc. The standard contains a rebuttable presumption that if it is 90 days past due, then it is defaulted. Like the same as what we have for NBA. So if it is 90 days, above 90 days, then it will be treated as. So you will have to make your case on a case-by-case basis if you want to rebut this. So in this particular instance, even though it has gone beyond 90 days, it is still not defaulted. You will have to argue on a case-by-case basis. So what is credit impaired or what is defaulted? Credit impaired. Now example of such events, significant financial difficulty, a breach of contract, default of past due, a lender having granted a concession to the borrower that the lender would not otherwise consider. The borrower is likely to enter into bankruptcy. Disappearance of an active market because of financial difficulties and purchase of financial asset at a deep discount. So these are all some of the examples that are provided. Again, this is not an exhaustive list, it's just an indicative list, so there could be other reasons as well. Now, so previously, you had this amortized cost. I just want to relate this credit impaired assets to the classification that we saw just now. Now, previously this HTM, I talked about this HTM category. So this HTM category, if there is an asset that is classified as HTM, you are not supposed to sell it. Why? Because you are supposed to hold it till maturity. But the exceptions are there. The exceptions are if it is likely to be credit impact. So you cannot travel on a sinking ship. You will have to jump out of it, provided you know swimming, that's different. But you will have to jump out of it, otherwise you will also. So that is one of the exceptions. Then this HTM, previously this regime used to be slightly like our in our school days, previously when I was young. So the teacher will have a foot ruler. So if you do something wrong, you have to show your hand. You have to show your hand. And before it is struck, the teacher says, show your knuckles, so that it will pain more, right? So if you hit the knuckles, it will pain more. Like in HTM, if you make this mistake, so you have done this sin, the punishment is you will have to transfer all the assets classified as HTM into trading assets. You have just made only one error, one mistake. You have sold only one against this classification rule. But then you will have to transfer everything. That is just showing your hand, but you have to show your knuckles, so it should pain even more. So the rule is, you cannot classify anything under HTM for the next 2 years. So that used to be the regime under IAS 39. Now fortunately it is not there. Now it's all prospective, so you don't have to worry about it. So if there is a violation, so prospectively you will not be able to classify that, right? So that's what it is. It is a lot more simpler regime. I thought I will tell you about this in this credit impact one. Okay, now let us see the overview. Now this is the essence. Then we will discuss the nuances of this one. What is the logic behind each one of this? Okay. Now this 12-month expected credit loss recognized in P&L through loss allowance. So it is through the loss allowance. Proxy for initial expectation of credit losses. For financial assets, interest revenue is calculated on the gross carrying amount before deducting the expected credit loss. So on the gross amount. So stage 1 includes financial instruments that have not had a significant increase or that have a low credit risk at the reporting date. So if it is a low credit risk, then also it is, you don't have to provide for enhanced one. So it will be treated as that 30 days. For these assets, 12-month expected credit loss are recognized and interest revenue is calculated on the gross carrying amount. Okay, now this is stage 1. Now 12-month ECL are the expected credit losses that result from the default events that are possible within the 12 months. It is not the expected shortfalls, cash shortfalls over the 12-month period, but the cash shortfalls are to be recognized over the entire life of the asset. It is only the probability of default occurring over the next 12 months that need to be considered. Now stage 1 over, stage 2. So if the credit risk increases significantly, then you will have to find out, then it moves to stage 2. So here also the interest income is the same, the recognition of interest income is the same basis, it is on the gross amount. For stage 2, the probability of default will have to be for the entire life of the asset, and the cash shortfalls also will be accordingly completed. Now lifetime ECL are expected credit losses that result from all possible default events over the expected life of the financial instrument. Expected credit loss or the weighted average credit losses. There is a rebuttable presumption that the credit risk on the financial asset has increased significantly when the number of days past due exceeds 30. We have already seen this. Then finally stage 3, where the number of days past due exceeds 90 days. Then you will have to provide it based on the interest revenue. The only problem is here the interest revenue. Interest revenue is to be recognized only based on the amortized cost, which is the gross carrying value less. So if the allowance, like for example, if there is a financial asset for say 1,000 rupees, the allowance is also 1,000, then you cannot obviously recognize any interest revenue. So that's the only difference here. Okay, now the standard says that you can do it on individual basis or it could be based on collective assessment. So if it is to be done on a collective assessment, then you will have to group it based on those financial assets which share common credit risk characteristics. So you will have to group. So this is normally possible for those assets like for example mortgage loans, housing loans, right? There are going to be series of loans, or there could be microfinance loans. So there are a series of loans, and based on the common credit characteristics, for example, loans given in the state of Tamil Nadu, loans given in the state of Maharashtra could be one group, right? Or loans that are given in those districts which are affected by Gaja. There was a cyclones from Gaja, like that. You can classify like that to find out what is the impact. So those are all the assets that share the common risk characteristics. You will have to group it by that. The entity should not obscure this information by grouping financial assets with the different risk characteristics. Otherwise, what happens? It becomes skewed. So you will have to ensure that it is proper. So some examples of shared credit risk characteristics are given. So which is instrument type, credit risk ratings, collateral type, date of initial recognition, just we call it as vintage. So all loans that are originated in 2007, all loans originated in 2008, etc. Then remaining term to maturity, all loans which have remaining period of 5 years, like that it can be grouped. So depending upon what is relevant, you will have to do. It could be by industry or geographical location. I gave an example of geographical location, and the period of default occurring, etc. Okay, now these are all some shared risk characteristics. Now the consideration for ECL. Yes.
What happens if it is the two different, both in two groups, A union B? Let's say it's in Tamil Nadu and also some other industry. Let's say build.
You will have to see which is more relevant. You can't have multiple groups like that. You will have to see which is more appropriate. Whichever is more appropriate, you will have to do. Again, see, the reason why we do it is more selfish interest, because if you try to group things which are not to be grouped, then ultimately the ECL is going to be more, because it is going to skew the history, the historical loss. It is going to skew. So better to remove those which are already skewed, so that portion will be less. So that way. Okay, so what are the general factors to be considered? Factors to be considered for ECL computation: segmentation. The segmentation is the most crucial one. Like, as he said, segmentation, how it has to be segmented. What is the most appropriate category? What is the most appropriate category which will say that these are all the common risk characteristics that can be grouped together? So that is the main thing. Then basis of arriving at the PD. So is it based on the DPD of the loan? There are several methods by which you can compute the probability of default. So we are going to see some cases now, practical case studies. We are going to see some cases. And it's not an exhaustive list. I have just brought some 3 examples. Then what is the methodology to be used? Whether it is discounted cash flow or based on some other methodology. It could be transition metrics, or there could be several other methods. Now, as far as the US GAAP is concerned, it lists about 6 to 7 methods are listed. In IFRS, nothing like that. It is all completely principle based. So you will have to decide what is the appropriate method that you need to use. Basis for computing the loss given default based on the transition matrix and not the incurred loss, and forward looking macroeconomic information. Now here, see, commonly whenever you talk about this ECL, most of them say ECL is equal to PD multiplied by LGD multiplied by EAD. I don't know how many of you have heard this one. So probability at default multiplied by loss given default multiplied by exposure at default. So that is the expected credit loss. In a nutshell, yes, the answer is correct. That is the expected credit loss. But unfortunately, this definition is what is given as per Basel and not as per IFRS. Okay, so it's completely different. So IFRS does not talk about this exposure at default. It doesn't talk about PD, it doesn't talk about LGD, it doesn't talk about any of those things, and it doesn't say that your ECL is to be arrived at by this method. What it says is very clear, it's completely principle based, and it just says that ECL is nothing but the present value of cash shortfalls. That's all, that's how it is defined, right? So how the cash shortfalls is arrived at, you have all interpretations, right? Because the cash shortfalls, you know how the cash shortfalls are arrived at based on the probability of default and based on the loss given default. For the loss given default, you have to consider the value of collateral. There are so many other intricacies that get into that. So based on that, you will have to compute. Okay. Now, see, many of some of these discussions are given under the basis for conclusion. Okay. So the standard, you have the standard, but also there is a basis for conclusion. This basis for conclusion is a very, very rich literature that we have, because that basically analyzes what are the various options that were considered, what were the various choices that were considered, and why each one of those were rejected, and why the current method is adopted. So that kind of a discussion takes place there. That gives you a lot of insight into the concept of ECL itself. Okay. So I just thought I will touch upon some areas which are relevant for us. Now, this debt instrument measured at amortized cost and at FEOCI, collecting contractual cash flows, is integral business aspect. Now, for this one, the effect of change in the credit risk are more relevant for the collection of future contractual cash flows than the effects of other changes, such as changes in the market rate. So that is the reason why this is very much relevant, because you have to collect contractual cash flows. Only for these two categories, collecting of contractual cash flows is important, which is those debt securities which are classified as amortized cost and those which are classified as FEOC. That is why I started this session with the classification itself, so that this will be clear for you. Now, the model should faithfully represent the economic phenomenon of expected credit loss. It should provide the users with relevant information about the amount, timing, and uncertainty of the entity's cash flows. Very, very key things as to what is important. It should also ensure that the amounts that the entity reports are comparable, timely, and understandable. So this is what is given there. Crux of this ECL. Now, the ECL addresses the criticism of the incurred loss model. We have already discussed this. The criticism includes the concerns that the model is overstated interest revenue in periods before the credit loss event. So that is the reason why we do that. Delayed recognition of credit losses, and it was complex due to multiple impairment approaches, and also because it was too little and too late. So these were the criticism. Now, this is a very, very interesting discussion. Okay. Now, when you buy a financial instrument, that financial instrument already considers the expected credit loss. Now, the argument says that yes, it considers at the time of initial issue. At the time of initial issue, the default probabilities are also factored in, and that is how it is priced. But what happens subsequently, the asset gets priced only based on the interest movements and also based on the credit risk of the entity. That's all. The default probabilities are not considered at every reporting period, and that is why this has to be considered. So that is the reason for introducing. So it does not amount to double counting. So the point I want to make clear is that ECL will not amount to double counting. Okay, even though, because the value or the price at which the instruments are traded does not include the ECL component. That is the point. Okay. Now, ECL is not directly observable. ECL in isolation are not directly observable. The credit premium is a component of the market yield for financial instruments. The The indirect measurement of ECL is a daily occurrence in the pricing of such instrument. A number of models assist in the market participants and regulators to measure the ECL. Okay. Next important point, probability weighted outcome. Now, you find out what is the default probability, and based on that you also find out what is the loss given default, and then you find out what is the cash shortfalls you have arrived at. But then this is only one of the scenarios that are possible. The standard wants you to build at least 3 scenarios. So the 3 scenarios does not necessarily mean that one should be a pessimistic scenario, another should be an optimistic scenario. No, that's not what is meant. So what is meant here is you have to have 3 different scenarios. So one scenario can be less optimistic, another scenarios can be more optimistic. Right? It need not necessarily be the base and then you have one below and one above. No, it doesn't mean that. You have the base and you can have one above that also, right? Or one below and one below that also, if the forward looking information, the macroeconomic conditions warrant like that. Okay. So what is given here is the probability weighted. So you have 3 scenarios, you assign the probability for each of these occurrence for these scenarios and arrive at the probability weighted number. That is what is to be computed. Now this is significantly different from the US GAAP. Now as far as US GAAP is concerned, you just have to have one scenario which has the maximum occurrence possibility, right? So even if it is the occurrence possibility is just 40%, the other 2 occurrence possibilities are 30 and 30, you will still choose this 40 because that is the maximum occurrence possibility. Whereas here, if it is 40, 30, 30, we will find out all the 3 and take the weighted average of all the 3. Timeliness, forward looking and segmentation, ECL on collective basis, I think we discussed all this. Appropriate grouping is very important. See, this appropriate grouping, to answer your question, right? So if it is not grouped properly, it will be completely skewed. And if it is skewed, you will be at a disadvantageous position. At the same time, you cannot aggregate everything into one group. Then you will be missing the missing the distribution available in each of these segments. You will be missing the distribution. See again, please note, this ECL computation is mostly quantitative, quant techniques. Okay, quant techniques are applied. It is not purely an accountant's job. Okay, so accountant, once the number is produced and given, we know how to account for it. But how to compute that is, I wouldn't say it is completely the accountant's prerogative, right? Because it is something more than that. It is quantitative. It's a quant techniques have to be applied. So statistical techniques, quant techniques have to be applied here. So the appropriate grouping. Okay. Now repricing. Wonderful discussion here. See, whenever there is a repricing, the repricing will increase or decrease the rate. Okay, the rate gets increased. The interest rate gets increased. It is because it is to compensate the extra risk. It is to compensate the extra, because of the extra risk undertaken, you can increase. But that does not mean that the default probability is reduced. Default probability still continues. So even after repricing, you will still have to do the ECL. So these are all some of the wonderful discussions that are given in the basis for conclusion. Now there is no specific method, so you will have to use the problem method. Okay. Now this prudential norms. So prudential norms, more or less it aligns, except that there is a absolute number that is given. Here there is no absolute number that is given. You will have to compute, but invariably you find that this will be more than the prudential norms. So the probability weighted outcome is what I said. Now the term, please read the 3rd paragraph. The term expected, as used in the terms expected credit losses, expected value, expected cash flow, etc. These are all technical terms that refers to the probability weighted mean of a distribution and should not be confused with the most likely outcome of an entity's best estimate. The most likely outcome is what is given in the US GAAP, and here it is not like that, right? So here it is a probability weighted average that you will have to take. Now, there is another technique that we use for in the transition matrix. We use a technique called Markov chain. So this Markov chain tells you that, supposing you have buckets, you have bucketed the dues, okay, into say 1 to 30, less than 0, 0, then 1 to 30, then 31 to 60, 61 to 90, like that you have bucketed. Then it will move from one bucket to the other depending upon the default status. So if somebody doesn't pay, then it will move from 1 to 30 to 30 to 60 and so on. So if you are tracking this on a monthly basis, that means every monthly data points you are gathering, a particular loan cannot move from the first bucket to the fourth bucket suddenly. Why? Because at best it can move only to the next bucket. Or if that particular person pays, then it can move one step forward, or it can move 3 or 4 steps because he is clearing 3 or 4 installments, it can become 0. But then it can't move from the first bucket to the fourth bucket, right? So this Markov chain tells you that is how it will move, and based on that you can arrive at what is the probability of default. That we will see an example. So another valuable feature is that it maintains the progression and timing of events from current to loss. For example, an account in the current state doesn't suddenly become a loss. It moves from one bucket to the other over the period. An account must progress monthly from current state to 30 days past due to the 90 days past due, etc., and then it becomes defaulted. So this is that Markov chain model. I will give you the example how it should be done. Okay, now this is the transition matrix. Now let us assume that there is a project. We'll see an example also with this, but I will tell you the concept here. Now this is a project loan, and this is the transition matrix that is published by most of the credit rating agencies. The credit rating agencies compute a 10-year average of all the loans that they have rated. They will prepare a 10-year average of all the loans that they have rated, and they will prepare a chart like this as to how a particular loan or a particular company has moved from one rating to the other rating at the end of every year. Like for example, in this one, 98.51% of those CRISIL AAA rated companies remained in AAA at the end of the year, whereas 1.49, only 1.49 slipped to AA. That means nobody slipped to A or BB. Whereas in the second line, if you see, 95.22% of the loans that are rated by CRISIL stayed in AA from the beginning of the year to the end of the year. The next year they have continued to be in the same. 1.47 actually bettered. They became better. They moved to AAA, and 2.82% became A, and 0.49 became BBB. Like that, this gives you the transition. Now, what does this tell? This tells you what is the probability that a particular loan can move from a particular rating to another rating at the end of the year. Like for example, if you say currently it is rated BB, okay, then the probability that it will default at the end of the year is it moving to D rating, because D is default. D rating is default. So it is 3.56%. So the PD is 3.56. So there is a 3.56% probability that this loan can get defaulted at the end of the year. Whereas if it is a loan that is rated AAA, absolutely zero probability that it will get defaulted. Right? If in fact if it is even AA rated also, there is zero probability. But again, please note, this is only where it stands at the end of the year, 1 year. Where will it stand at the end of 2 years? You have to multiply this matrix by 2. So that means you have to multiply this matrix by the same matrix. So in other words, you raise this matrix to the power of 2, then you will get how it will be at the end of 2 years. If you raise it to the power of 3, you will know how it will be at the end of 3. Now, if a particular loan is the DPD of this loan, let us assume the DPD of this loan, days past due of this loan is 16 days. Then you have to find out 12-month probability, right? Because because it is not the credit risk has not increased significantly. It is less than 30, so there is low credit risk. And if it is rated, say BBB, then you just have to multiply this value, the outstanding amount, with how much? 0.9, and that will be your ECL. You understand? But then, if the number of days past due is 35, not 16, but instead it is 35, that means the credit risk has already significantly increased. The credit risk has increased significantly, and then you should find out what is the maturity period of this loan. So if the maturity period of this loan is 3 years, then this table is not useful for me. I will have to raise this table to the power of 3, right? So I have that here. So this is the 2-year matrix, 3-year matrix. Now the same BBB, it will be 0.62. So in 3 years, it will be 0.62. Or if it is a BB rated, you will find that in 3 years it will be 10.61. So what was let me go back. So what is the 1-year matrix? 1-year matrix for BB is 3.56. From 3.56, what happens? It becomes 10.61. At the end of 3 years, you will have to multiply. That means you have to multiply the outstanding amount by 10 point thing to get the ECL. Is it clear? Okay, this is what is called as a transition matrix model. We have already discussed this. Okay, now apart from this probability of default, you also should consider forward-looking information. So this forward-looking information are mostly the macroeconomic indicators. These macroeconomic indicators could be it could be consumer price index or unemployment rates, then the actual interest risk-free rates, okay, then gross domestic product, or it could be any other data. So there are about 300 different types of data that are available if you subscribe for Economist Intelligence Unit. Okay, EIU, if you subscribe for EIU, 300 different macroeconomic parameters they give you. But then all of these things may not be relevant to you. So you will have to find out what is relevant. So how will you find out what is relevant? You will have to find out historically what has been my losses, defaults. In other words, what is the one that is due beyond 90 days? That is my default, right? So you find out what is my default. And you also find out what these parameters were during those periods and try to find out a multivariate regression table. You have to find out a multivariate regression. Then you will get, supposing you are considering 3 parameters, like for example you consider consumer price index, you consider interest rate and gross GDP, then you will find out what is the intercept for each one and what is the slope. So y is equal to mx plus c. So based on that you will find out what is the intercept, what is m is the intercept, okay, and m is the slope and c is the intercept. So you will have to find out what is y, which is the dependent variable. So find out the independent variable and the dependent variable, find out how it moves. Now you have to ensure that this regression test actually satisfied, the regression test qualifies. In other words, you should see what is the f value, f statistic value. F statistic value should be less than 5% and your r square should be more than 0.5. Your r squared should be more than 0.5 in order to say that it is statistically valid. So you'll have to find out what is statistically valid, and if it is statistically valid, then you take those 3 parameters, right? You will find that if you take these 3 parameters, you will find that your r squared is not 0.5, it is less than that, or your f value is significantly high, so which means that null hypothesis is gone. So then what you do, you remove one parameter and add another parameter and then do the same regression testing. Like that you will have to do this multivariate regression testing to find out what is. That is why I said some of these concepts are beyond our accountant's purview. So it is all mostly quant related techniques and so on where you will have to apply this. But then this will give you what is the likelihood of the various scenarios, right? So you find that there is a perfect regression, it satisfies the regression testing, then you will have to say, okay, if the based on you already have the forward looking information, you have the GDP for the next 2 years projected, then you know based on that how much will be my default. So you find out how much my this thing should be bumped up and bumped down. So what should be those factors, apply those factors and get those 2 scenarios. So I have one practical case study in that we will see that, then you will understand this. So the same thing whatever I explained I have given here. Okay, now this is the summary. So just look at the summary, we have all seen this several times. We will get on to the practical case studies, okay. Any doubts so far? Any questions? We'll pause for some time. Yes, please.
Was that for the, in the previous slide you mentioned the loan repayment, considering the macroeconomic factors. Was that for the, receivability part or the loan availed by the company, and we are looking at the repayment part, default by the company itself? In determining the ECL.
Yeah.
We had looked at the macroeconomic factors like GDP. You will not expect to default on your own loan. That's what. We moved on to financial, the liability part we looked at.
No, not liability, asset only.
The
See,
default on your own loan.
No. This is your loans that you have given, not loan taken.
Okay, we are determining from, correct.
You have lent, right? So basically, so it's an investment. So all these loans are financial assets. We are not into financial liabilities.
Sir, what about sovereign debt?
Sovereign debt, it can be taken as 0.
But theoretically, you will have some figure.
A lot of discussions. Yes, take some. Yes. So the answer is you cannot take 0. Even for sovereign debt, there is a little bit of probability of default is there. Yes. Okay. Now you will see project loans. So this is the loan that is given. Same thing I am going to see now. Okay. So you have project loan outstanding 23 lakhs. So recovery rate 25%. Now see, for normally, this is just theoretical. This 25% is theoretical. Okay. So you can find out what is the recovery if you have series of so many such loans. Normally there won't be, right? There will be only one such loan. So for project loan, it is usually we take the recovery to be zero because it doesn't have any resale value. So recovery is taken as normally zero. That's what we do on a conservative basis. But for the problem, okay, let us understand the problem. So do you understand how it is computed? The recovery rate, I am assuming it as 25%. So the loss given default is 75%. So I will recover 25%, loss is 75%, 1 minus recovery rate. The date of acquisition, maturity date. And I think the date, okay, valuation date I have given. Valuation date is 31st March 19. Now the case 1, case 2. Okay. So, first I put scenario, but scenario means three different scenarios we need to compute. So you will be confusing with that. So I made it as case 1, case 2. So two different cases. So case 1 where the date of acquisition was AA and case 2 it is B, and on the valuation date both are B. Okay. Now for the case 1 we can assume that the credit risk has increased significantly because from AA it has moved to 2 notches, because AA you have A minus, then you have B, right? Triple B, then BB, then B. So we can say that it has fallen substantially. So we can say that the credit risk has increased significantly in the first case, and in the second case, credit risk has not increased significantly. So for case 2, you will have to find out what is the default probability for just 12 months, whereas for case 1, you will find out the default probability for 3 years. So 3 years. Now this is rated by appraised by CRISIL. So we have this same transition matrix. Okay. Now the original credit rating of the loan is AA. On the date of valuation, the credit rating is B. So the credit risk has increased significantly since the date of acquisition of the loan. So that is the conclusion that we are drawing. Hence the lifetime default probability should be considered because it has increased significantly. So what is the lifetime? Lifetime is remaining period is only 3 years. So 1 year transition matrix based on 10-year average. Now this is a public domain, it's available in the public. So you search for CRISIL transition matrix, you will get this one. So take that one and that gives you 1 year transition matrix. Right? But then this is no use, we'll have to multiply this over and over 3 times. So multiply this, so in other words you should raise to the power of 3. So the 3-year transition matrix, so B rating is 21.91. So B becoming D, B falling to D is 21.91% probability. So your default probability is 21.91. So understood now where the 21.91 is there? Okay. So now this ECL would be 21.91 multiplied by 23 lakhs multiplied by LGD. Loss given default is 75%. But you can have 2 more scenarios with the probability weighted average to be computed. So technically you should also find out 2 more, because the standard says that you can't stop with 1 scenario, you should have at least 3 scenarios. So you should probably say, okay, there could be a 0.5% more probability that it can default, right? And there could be another 0.25, because considering the today's economic scenario, there is a downturn all around world. The world there is an inverted interest curve. So many things they are saying every single day. So you may say, okay, there is a probability that the default loss, the probability default could be 1% more. There is a 50% chance that the default because this is historical, right? So based on the forward-looking thing, you can say that instead of 21.91, I will say 22.91, right? And I will say that the probability that it can be 20.91 is only 10%, but probability that it is 22.91 is probably about 60%. So 60 plus 10, and the actual this thing will be 30%. So 30% will be the current. Like that, you can make assumption based on valid reason, or it could be based on some statistical significance testing, as I explained to you before. Now, case 2, the risk has not increased significantly, even though both are in B rating. The risk has not increased significantly. You just need 1 year transition matrix. So you can make use of the first one itself. So BB is 3.56. That's it. So you just have to calculate it based on 3.56. No, sorry. B is 8.27. Sorry, 8.27. 8.27. That's it. Okay. Then, so what we have seen is the transition matrix method. Okay, now this will be discounted cash flow. Now this DCF method, there is a loan, the category construction equipments, principal outstanding 23 lakhs, discount rate 9%, the coupon is also 9%, the probability of default. Now, how did we arrive at the probability of default? Based on regression analysis. It is independently based, I'm not combining both. So now you have this at 6%. 6% is the default probability. So it could be arrived at by so many means. This PD could be arrived by so many means. Okay. So, and the loss given default is usually the historical. So whenever the loan becomes defaulted, what is the recovery that is possible? Is all historically available. So you have to take at least 3 years average and then find out if there is a default, this is how I will collect. So this LGD is purely an exercise that the company will have to do based on the historical. Default probability, several methods are there. You have what is called as an ARIMA simulation method. So many methods are there. Okay, so assume that it is computed at 6%. So based on this, you arrive at what are the amortizing balance, what is the payment, what is the default, what is the loss, what is the recovery. So default losses is that 25%, recovery is 35%. Okay. Then principal and interest, fair value. So the fair value gets discounted, and the discounted fair value is 2383. Now this 2383 is your principal outstanding is 23 lakhs, and the fair value credit PV, that is actually the present value of the cash shortfall. Actually this is not the cash shortfall, this is the present value of your entire cash flows, where we have already considered the default probability and we have also considered the losses. So the actual what is going to be the cash that is going to be received, we have found out the cash that is going to be received, and then we have discounted each one of those cash flows and found out the credit present value. This is called as credit PV. We have found out the credit PV. So the difference between the principal outstanding and the credit PV will be your ECL. Now this is your scenario, and based on the regression with the forward looking information, I found out that the probability of this is 50%, and another probability of, there is only 10% probability that the default percentage will be 8%. So the default PD of 8%, there is a 10% chance of the PD to be at 8%. So both are probabilities, so don't get confused. Here we are talking about the PD of the default. This is the default probability, that is the probability of occurrence. So there is a 10% probability of occurrence where the PD could be 8%. Clear? So based on that you find out the same thing, you find out what is the principal interest, what are all the cash flows that are occurring, and the cash flows gets discounted back, and you find that is 2278. That means it is expected credit loss. I'm sorry, page jump. So the expected credit loss in this case is 21 because 8%, 21. Then the other one is 4%. So obviously it will be less. The default probability is just 4%. So your ECL is 10,878. So what do? You similarly find out what are the losses, what are the recovery, find out the cash flows, discount it back, and find out the credit PV. Now the final step is, there is a 40% occurrence probability of 4%, and 40% is scenario 3, 10% is scenario 2, and 50% is the base scenario 1. So find out the weighted average of all the 3 and 14,608. That is your ECL for a loan which you have given amounting to 23 lakhs. Today the principal outstanding is 23 lakhs and the expected credit loss on that is 14,608. Is it clear?
In this example, you assume that the credit risk has not significantly increased. So you have considered only for the next 12 months, right?
Okay. See here, here we have assumed okay. Now that is a good question. Now I didn't say that, right? So I said for this one the PD is this. It could be 1 year or it could be lifetime. So if it is, if the number of days past due for this is more, because statistically I have arrived at what is the PD, 1 year PD, what is the lifetime period. I have both the numbers. Okay. So depending upon the number of days past due for this particular loan, I don't know. Okay. So it's a good question. I didn't provide anything like that. Now let us assume this is 1 year PD.
Yes, because you have calculated only for 10 number of terms, which effectively means 10 months only.
Yeah, that is true. It is only 10 months. Yes. It could, okay, it is only 10 months. So we can assume that it is. Now it could be for a period of 5 years also. And yeah, see whether it is, even if it is 90 days also, it will be only because only 10 months is there. So the default probability will be there. Lifetime PD will also be 1 year only. Correct, you are right. Good point. Understood what he said? So irrespective of whether it is this thing, it is only a 1 year PD because the total duration is only 10 months. Any questions on this? Any doubts?
The practical scenario, how will you do for such a portfolio of cases for a bank?
There is no shortcut. See, if there are please listen. These are project loans. Okay, so project loans are expected to be few and far between. Okay, so usually if these project loans are rated, most of these project loans are rated. Then we go by the first method. First method is fairly simple. So this is a case where it is not rated, right, and where you want to follow DCF. Right. See what happens is that most of the loans, smaller loans, like for example it could be automobile loans, etc., where you have arrived at separately the PD for different segments, for 3-wheeler, 4-wheeler, like that you have arrived at that. You already have the PD, 1 year PD, lifetime PD. You also have the LGD for that based on the historical. All that you have to do is to substitute that in a Excel formula, and it gets. That is possible. So even if it is some 70,000, 80,000 individual loan items are there, it is still possible to be done. That's not an issue. Okay. Now the last case, receivables. Okay. Now this receivables, accounting policy choice, trade receivable and contract asset that do not contain a significant financing component, always apply the simplified approach. There is no choice. So the simplified approach, we will see what is the simplified approach. Then trade receivable contracts that contain a significant financing component, you can either use the general approach or simplified approach. Now this general approach is what we have seen so far. Simplified approach is you have to consider lifetime PD. So you don't have to worry what is my 12-month PD and 1-year PD. That is a huge burden on the part of the company to find out whether the risk has increased significantly. That is one. The second one is you need to have two different numbers. But for receivables, normally receivables, the duration itself will be less than 1 year, because if it is going to be 5 years, then they are really not doing proper business, right? So it should be less than 1 year. So it is better to have a 1 year lifetime PD. It's called as lifetime PD. That's it. So you don't have to worry about lifetime. The lifetime can be 3 months, lifetime can be 1 year, whatever. So the lifetime PD, that is what is called as a simplified approach. You don't have this two-stage recognition of risk. Lease receivables also, you can use the general approach or the simplified approach. Okay, now what is this simplified approach? Step 1, determine the appropriate groupings. You have to find out the grouping can be based on those assets which share the common risk characteristics. So that still contains the same thing. Like it could be geographical, product type, consumer rating, collateral, trade credit insurance, type of customer, wholesale or retail, right? So aggregate the receivables into groups that share similar credit risks. The second step is determine the period over which historical rates, loss rates are appropriate. So you have to determine the period, right? So typically the period should be a representative period. You can't say I will take only 6 months data, no. Or you cannot say I will take 10 years data. That may be too big, right? You may probably be missing out something. So typically it could be 2 to 5 years. 2 to 5 years is an ideal number. So take the data relating to this 2 to 5 years, and historical data should be collected for each subgroup. Judgment is needed to determine the period over which the reliable historical data can be obtained. The time period should be reasonable, not unrealistically short or okay. Now the third step is determine the historical loss rate. So determine the loss rates for each subgroup, divided into the past due categories. For example, loss rate for the balance that are 0 past due, 1 to 30, 31 to 60 and so on. Find out what is the loss. So you know what is the total loss at the end of the period. Find out relating to these buckets, if it is expressed as a percentage, how much it will be. It's more like a cash flow model. So consider the forward-looking macro information, macroeconomic factors to arrive at appropriate loss rates. Now this is again based on the regression. You find out what is the appropriate number to be adjusted. Like for example, you say okay, in Tamil Nadu, I don't know, IMD, because of the forecast, we find that the rainfall is not going to be that great. You may probably it is going to affect all your receivables, so you may want to add 0.5% more. Or in some place in say Maharashtra, there has been too much of rain causing so much of disruption. You may want to add 1% more, right? The loss. So like that you will have to decide based on that. These are necessarily not the final loss rates because you need to adjust it with this one. Now finally calculate the expected credit loss for each of the subgroup. Now let us go to a problem. Now here, so the period is 2-year period. We are analyzing a 2-year period. So in the 2 years, what is my total sales? Now the appropriate classification I have taken as 2 different states, Maharashtra and Tamil Nadu. So what is the sales happening in these two states? Accordingly, I will also have to find out what is the collection data in these 2 states. Based on the number of days. So what is my total sales and how this is collected over the remaining periods, like till 180 days. Beyond 180 days, I want to write it off. So this is how this is the collection data. Now based on this data, we will do the analysis. So what is the credit sales made? Credit sales made, you find out how much is collected. Then 381 minus 117 will be 264. Like that you keep deducting and find out the percentage of this loss above 180, because above 180 I am going to recognize it as loss. So I am going to write off. That means that is the loss that is incurred. So how much of that 4 lakhs? How much is 4 lakhs as a percentage of each of the outstanding balances? So that is typically my loss. So if I know what is the balance now, what is the balance receivable as on today, which is bucketed into these, then I just have to simply multiply with these loss rates to arrive at the likely loss. Right? So what I've done is, so this is the loss rate. I just applied the loss rate. I know the receivable balance, receivable grouped into the appropriate buckets. But then I'm adding an adjustment for macroeconomic data. So this macroeconomic data adjustment will be done based on, already I've explained, regression, blah blah blah. You find out the adjusted loss rate, and based on that you arrive at the ECL. So similarly for Tamil Nadu region, you find out what is the loss rate, and once you find out the loss rate for the respective buckets, arrive at the adjustment for that, and based on the adjustment find out the ECL.
It exceeds the outstanding balance.
Hmm?
How can the loss rate be more than 100%? That's the point.
Where?
The last one, above 180 days, you are making an adjustment for the macroeconomic data. The loss
Okay,
can
okay.
never be more
Yeah,
than
yeah.
the actual outstanding.
Correct.
That's what he's saying.
Yeah, that should be only 100. But again, see this one. Okay, I don't know. This one is more an adjustment, because from the overall perspective we are adding 0.5%. Maybe it is right and wrong. I don't know. So what are
Can this adjustment be vary with the number of days or something like?
Sorry?
So this adjustment what you are making?
Yes,
can
of
it-
course.
Can it also vary with? So it
Yes,
depends on the
it
economic
can be
factors.
more refined. Yes, of course. It
Macroeconomic
can.
factors.
Yes, it can be more refined. Yes. So these are the 3. Okay, I just wanted to show you this one, this regression analysis. So here, the 3 factors that are considered are risk-free rate, 1-year risk-free rate, inflation, and GDP growth rate, real GDP growth. So we are regressing this with the independent variable, and so these are independent variable. The dependent variable is the default. So based on this, if you do the regression, my significance F test is less than 5%. So that means it is passing, and the R square is more than 0.5. So adjusted R square, because I'm using a multivariate regression model. So you have to take the adjusted R rate and not the adjusted R square and not the R square. So the adjusted R square is 0.64, and based on this coefficients, and you will use these coefficients and the intercept. You will use the intercept and the respective coefficients if you want to extrapolate this for the next few dates.
Can you go back to the previous slide? Then you have taken above 180, and you said that is your loss in which you have proportionated to to the outstanding. Now what happens if I don't anything like more than 180? Can I say that so there's no loss and I don't have?
No, but it depends. That's what see. At what stage you write off? What is your write-off policy? you may write it off at 90 days. So what is the loss you are accounting in your books? That's what is the key here. So here I am saying that above 180 I am going to write off. So that is a loss. I am recognizing the loss at that stage. So it varies from entity to entity. Your accounting policy.
It can be more than a year also.
It can be more than a year
3
also.
years also.
Yes. Typically, yeah. Yes.
So which means you need to take out the data every year and
Yes.
what.
Correct. I mean, see, this exercise has to be done. Yeah. So last 2 years data like that.
This is to be done for each bucket, is it? Separate?
Yeah, I mean,
Industry
based on the
wise.
flow, you find out what is the percentage for each bucket.
That's what.
But the bucket can change every year.
Usually no. Usually no.
But it's a rainfall, Maharashtra thing, once.
No, but yeah, the bucketing cannot change. Of course, the loss rate will change depending upon the actual performance data, right? Because the last, that's why you're taking the average of the last 2 years. So you avoid the noise. You do away with the noise. Any doubt? We have covered the ECL portion with some practical case studies.
Tell me something. From your experience, you think going through such a huge exercise to find out what is my credit loss is really worth doing it?
I will say yes, it is worth it because you are avoiding shocks.
But
That
do you
is-
think then can you not get one industry average and so that they apply it so that probably that would be a better indicator?
No, but see the problem is then you are completely generalizing it too much, right? See again we are going back to the previous regime where you just have some ad hoc numbers. So here there is no ad hoc numbers. So previously we used to do this ad hoc numbers, and the auditors were satisfied if the ad hoc numbers are quite huge, so that their skin is safe. But that is not the right policy because there is no hidden reserve. There is no concept of any hidden reserve. So you have got to be realistic, not pessimistic. Previously we used to be pessimistic. Now we want to be realistic.
Are there any discussion on why HTM was considered as a set as such? So once it is defaulted, the entire thing is grouped as such. Right?
HTM?
Is totally anything defaults, the entire team is taken out,
Yeah.
right? And whereas other option, non-HTM, we have so many varieties, so many bucketing systems and things like that, varieties. Our calculation of the probabilities is also changing. But is there any reason or anything explained on the basic principle which is adopted?
No, HTM is the previous regime. Now there is no HTM.
Okay.
Right? Now the HTM is gone. There is no HTM. Now it's all amortized cost. HTM, as I told you, is a bad word. So we should not be using that HTM. Even though RBI is yet to come up with a circular which will classify it as a different name. Today still the banks do, but actually as per IFRS 9, as per Ind AS 109, there is no HTM.
Sir, I will reduce the amount of ECL against the outstanding balance each year. Sir. Each year I am going to recast that my cost.
No, this will be taken as an allowance. You don't. This is an allowance. So you are not reducing it from the debtors. This is an allowance. So you will keep it separately, and then because this can go up and down. This is not a write-off as such. Just an allowance.
Provision.
Yeah. Provision. So if you don't have any other doubts, we can close it. And thanks for your attention. Thanks for your time. And it's been nice.
Thank you very much.